Yes, I'm right. We're up 12% from the budget on the index. And budget was 1st of Feb. Today is 17th of Feb. Not even 20 trading sessions, and you pretty much have added what everyone thought would be the gain for the quarter, or at least for next 6 months. Jinesh Gopani joins us now. Jinesh, good morning. Thank you for joining us. All right, Jinesh, what is the right way of looking at this market? A market which is telling you that strong economy, strong earnings growth, strong margin expansion is coming, or a market is telling you, bhai, bahut ho gaya hai, it's time to get careful now?
I think always you need to be always cautious because something or the other comes and hits you. There are always some kind of black swan events every 1.5 years. We have seen from demonetization to GST to LNFS crisis and now COVID. Having said that, I think the tone of the market post-COVID, because COVID was also a once in a 100-year kind of an event, looks like the recovery in the organized space is much faster. The job losses are relatively low in the organized space, and hence, if you really see most of the listed companies which are organized have really been able to demonstrate on earnings capability and visibility and also gaining market share. And I think that is where markets have been on a tear, and adding to that is a good budget, a pro-growth budget, no-nonsense budget, government means business. So I think the focus has shifted really to a pro-growth mode. And if you have a 14% kind of a nominal GDP growth this year, and then from there on you get into, let's say, around 10 to 11% kind of a nominal GDP growth for next another 2 years, I think you are in for a good run. However, I must say we should be cautious in terms of if at all there are any COVID-related further shocks, if at all it comes, or if any kind of a black swan event in the global world if it comes. Also, if you see markets are on a flow basis, there is a lot of money which has come into the markets. In fact, as you said, markets are up 12%, and there has been, in cash market at least, there is a 20,000 crores buying which has happened from the FIIs, and markets up. So really, I think we are getting now fair share of flows in the emerging markets, and if some of the reports which talk about, let's say, around $250 to $300 billion of flows which can emerge over next 12 to 15 months time frame, we should also be benefiting. The flows can be back-ended or front-ended. That is depending on how the situation arises. So volatility will be your friend. It is always better to be cautious than go overconfident on the markets.
It's not a great market, it's not a terrible market as well. How much importance would you now pay to the spike which has happened in the US 10-year paper? I know it's slightly technical for our viewers here. That's why I'm requesting you to share your thoughts, because if the bond yields globally start spiking, that could in a sense be a big wrinkle or a challenge in terms of our assumptions of low yields, low rates, lot of liquidity.
Correct. So I think that is what I'm trying to say, that if there are any kind of significant shocks, let's say US 10-year just goes up dramatically, then I think there would be shock in the market and you will see one leg of outflow happening. Having said that, we still have to see whether it really holds on to this level or it breaks past and goes above, or it again tapers down. So I think that will be seen over a period of time how Federal Reserve is able to manage the yields, because I think it will hurt them also at some point of time. So unless and until it's a demand-driven inflation and the yield starts going up, then there is a cause of worry. Excessive inflation and yield starts going up significantly. However, at this juncture, it doesn't look like that type of a scenario. But as I said, that it is better to be cautious at the levels where we are, at the valuations where we are. But there is no need to panic, I would say.
What has been the big change in your portfolio orientation this year? Because this year, the dynamics have changed, and the dynamics have changed dramatically post-budget.
Correct. So I think, Nikunj, if you really see during COVID, there was a lot of fear what will happen to the economy, and I had come on the channel also that time. We had spoken about financial as a sector because it's a leverage play, and there has been a dramatic upturn both in terms of the numbers, the ability of some private sector banks, some NBFCs to manage the asset quality better. And now that you are getting into a growth mode and the asset quality issues are less, financials as a sector, we have been overweight. We had trimmed down during COVID, but we had gone investing once we got the understanding how the asset quality issues are shaping up. Also, after the budget, if you really see some of the sectors which can really do well over a 2 to 3 year period is financials, and I'm including everything because it's an underpenetrated market, India, and there is a lot of scope for good players to be in. Also, as tier 2, tier 3, tier 4 players goes sideways for various reasons in the sector, the top 4-5 banks, 2-3 NBFCs should gain market share. So that is a clear good run available unless there is some shock in the economy. So it's a backbone to the economy. It's a proxy to play economy. Second is there is a lot of thrust going into infrastructure. However, it will take time for really these infrastructure stories to play out. But you can play either through cement sector or steel sector or capital goods or any other infra proxies which are available to play. I think that could be a good story over next 2 to 3 year period. Technology as a space also globally looks pretty strong. So that also we continue to invest more. So these are, I would say, broad three sectors which looks promising over a period of time. And ultimately, consumption is an evergreen story. So you pick your stocks in those tech sectors.
Jinesh, taking from what you were talking about with regard to technology, and yes, while you still have substantial holdings, some profit booking also I see in some of the heavyweights with the recent sales in TCS, Infi, for example. So is there a strategy here? Is it just profit booking at this point? Are you looking for slightly more mid-tier names? I noticed the Tata Elxsi, for example, or would you continue to add when it comes to the tech basket? I also noticed, tech apart, but we also don't see too much of or anything. I mean, I know there are limited names, but from the telecom basket either in your portfolio.
So if you see technology post-COVID, there has been a significant ramp up in some of the TCVs, order books for all the companies, I would say. And technology looks to be in a sweet spot, at least for next 18 to 24 months. That is what we get the understanding from the companies that really digitization, technology, cloud, AI, machine learning, all is coming together and helping many enterprises to really ensure that the business survival is at place. And that is where Indian technology companies who are more of a service system aggregators, I think they are also benefiting out of it. So I think all across, most of the companies have been able to gain TCVs. The body languages are pretty strong, and they really are talking about good 18 to 24 months of good run, maybe double-digit growth for 2 years. That is how the technology space is moving. Telecom, frankly, it's now a 2-player market. We are evaluating. We have some of the stories in some of the portfolios, but we'll have to see how really the game plays out in terms of hike in tariffs or hike in ARPUs. How the auction, the coming auction pricing moves. So it's a high capital guzzler sector. Normally, as a house, we prefer more free cash flow driven companies. So we are evaluating. We have some in our portfolio, but not significant on that.
On tech, when you were talking about the infra play, let's go back to that as well, because a couple of your key holdings, and I noticed in Ultratech, for instance, you're obviously going to be playing this recovery through some substantial names that you see an opportunity in. And Ultratech, for instance, also looking at a massive capex revival going forward. Talk to us about what you feel will be the front runners when it comes to the infra and the infra play, as well as some of the proxy plays to that, and really where you see the maximum potential for returns.
See, I think we'll have to see how this capex really comes out, how fast the implementation happens, and how fast the execution starts. See, post budget, I think it is more of an euphoria that there is a focus of government on the infrastructure side, but really it has to now get into a project mode, implementation mode, and the execution mode. So I think, I think there is not one sector or one subsector which will do very well and the other infra proxies might not do well. But I think it is all across. You pick your stocks depending on the sectors where you are comfortable, depending on the managements where you are comfortable, and the corporate governance issues are less. Anything which really helps building home or building roads or building ports or building bridges, I think there are product companies in the capital goods space. There are cement companies who will really benefit. If you want to play momentum, you can play it through steel sector, and there are other niche sectors related to building materials and all those stuff, which you can play around depending on where you really see growth momentum. See, growth momentum is going to be all across. You have to pick your stocks depending on the corporate governance, the ability of the management to withstand the shocks, and the balance sheet of the company. If the balance sheet of the company is strong, hopefully debt-free companies, I think that is where the maximum gain would be made.
Sure. Jinesh, how is it that you've been reading into the entire auto recovery that is taking place, and not just the pure play, automakers, but it's the ancillaries which are seeing a bigger move, given that, there's always that looming threat of EVs now with Tesla as well, setting sharp. JLR just day before indicating that they're going to have the first EV vehicle in India by 2025. Having said that, the components, while they may be lesser in an EV, but the basic ones don't really change. So would you say tire companies, some of the other part manufacturers, they are the ones which are still good to go, EV or not?
So it depends on how many technology plays are available in India to play. I think there are very few players which can really scale in the auto ancillary space and talk about either technology or mundane stuff of just manufacturing local parts and sending it to ICE players as well as the EV players. So there are very few real breakthrough technology companies available in India to play on the EV side. So I think it is still work in progress. Hopefully we'll have some of the IPOs which will really open up opportunities to play EV space in a big way. But generally, it's a big disruption which is coming. I don't know whether it will take 5 years, 10 years, or 20 years, but it's a theme which is at play. Genuinely, people with as ESG as a process getting more and more important across the stakeholders. I think people are also opting to buy more of a cleaner fuel, green fuel cars, than opting for diesel cars or something like that. So I think it's a big disruption in play. It happens slowly, but obviously the more important part is to understand what ancillaries or what auto ancillaries would get derated. I think that is more important than looking at the opportunity, because there will be many auto ancillaries which we feel that might not be able to stay on course, and as a business model over a period of time might get derated if they don't change their game fast. So that is where it is better to look for companies in that space which would eventually will be a non-starter or a derating candidate and just take it out from the portfolio. Then looking for new, because as I said, in India there are very little not many companies available to play if you want to really play in a big way.
Sure. Jinesh, also wanted to understand what really is going on with retail, or rather tech-enabled retail, if I can call it that. We've seen, and that's been an ET9 exclusive, that Tatas are looking at a big pie or big basket. It's a sizable valuation of 9,500 odd crore rupees that is being talked about, directly in competition with the likes of Reliance Retail as well as DMart 2 to a certain degree. Do you think this is a space which is going to be capitalized in the near term to come, where the larger players are only going to gain more and more market share? Or would you say that this is a space big enough wherein there is scope for smaller players as well to get a piece of the pie?
Yeah. So if you really take global experience, there are always, if I'm correct, 5 to 6 players market in this space, in the retail space. So 2 or 3 will be a small niche player, and 2-3 will be a big giant. It's not like telecom where globally it's a 2 or 3 player market only. So retail is a very big pie. India thrives on consumption. If customer is moving that side, it becomes more important for companies to move that side, and hence you would see why some of the companies from offline has moved to online model or trying to set up the online model, because customer is moving that side, and there are different set of customers whom you can target on that. It requires huge capital in the initial, because the cost of acquisition of this customer is very, very tricky, as the billing invoices are in thousands or 2,000, and hence cost of customer acquisition is very, very high. So only the large players who have deep pockets can really pull through over a period of time. So it's a great space. There is a lot of opportunity available. If I remember correctly, only 10 to 12% of the market is a modern retail market. Rest is still available to grab. And if customer is ready to move that side with the available of smartphones and ability to order online without any challenge, I think post-COVID all these themes have become more important, at least in some of the top tier cities. It's a long-term story. There is huge opportunity, and if played well, then economics can be pretty good.